Hi everyone. In this video, we'll talk about classification shown in the balance sheet and discuss the assets that should be classified as current assets. Illustration 3-1 in your textbook shows the classification elements within a balance sheet. The usefulness of the balance sheet is enhanced when assets and liabilities are grouped according to common characteristics. The broad distinction made in the balance sheet classifications is current versus long-term or non-current classification in both the asset and liability sections. Current assets include cash and other assets that are reasonably expected to be converted into cash or consumed or used within a one-year period of time from the balance sheet date, or within the normal operating cycle of the business if that's longer than 1 year. The operating cycle for a typical merchandising or manufacturing company refers to the period of time from the initial outlay of cash for the purchase of inventory until the time the company collects cash from the customer as a result of the sale of that inventory. In some businesses, such as shipbuilding and distilleries, the operating cycle extends far beyond 1 year. For example, if it takes 2 years to build an oil-carrying supertanker, then the shipbuilder will classify as assets those assets that will be converted to cash or consumed within 2 years from the balance sheet date. But most businesses will use the operating cycle that is shorter than 1 year. In these situations, the 1-year convention is used to classify both assets and liabilities. Where a company has no clearly defined operating cycle, the 1-year convention is used. It is common practice for individual current assets to be listed in the order of their liquidity, and liquidity is the estimated amount of time it would take to convert that asset into cash. So in order of liquidity, usually cash and cash equivalents are listed first, then perhaps short-term investments, followed by accounts receivable, followed by inventory, followed by prepaid expenses. Your textbook shows an illustration of current asset section of Nike's comparative balance sheets. The most liquid asset, cash, is listed in the current asset section of the balance sheet first. Cash includes cash on hand and in banks that is available for use in the operations of the business, and such items as bank drafts, cashier's checks, and money orders. Cash equivalents are defined as short-term investments that have a maturity date no longer than 3 months from the date of purchase of that short-term investment. Examples include certain negotiable items such as commercial paper, money market funds, and U.S. Treasury bills. These items are listed as cash equivalents because they are highly liquid investments that can be quickly converted into cash with little risk of loss. Cash that is restricted for a special purpose and not available for current operations should not be included in the primary balance of cash and cash equivalents. These restrictions could include future plans to repay debt, purchase equipment, or make investments. Restricted cash is classified as a current asset if it is expected to be used within 1 year from the balance sheet date. Otherwise, restricted cash is classified as a long-term asset. Investments that cannot be classified as cash equivalents that a company has and the ability and positive intent to sell within 1 year or operating cycle if longer, are reported as current assets and shown as short-term investments. These investments include items such as equity investments in the common stock of other corporations, as well as debt investments in commercial paper and U.S. Treasury securities. Accounts receivable result from the sale of goods or services on account. Accounts receivable often are referred to as trade receivables because they arise in the course of a company's normal trade. Non-trade receivables result from loans or advances by the company to individuals and other entities. When receivables are supported by a formal agreement or note that specifies payment terms, they are called notes receivable. Accounts receivable are usually due in 30 to 60 days, depending on the terms offered to customers, and are therefore classified as current assets. Any receivable, regardless of the source, not expected to be collected within 1 year, or the operating cycle if longer, is classified as a long-term investment. In addition, receivables are typically reported at the net amount expected to be collected. The net amount is calculated as total receivables less an allowance for the estimate of the amount of uncollectible accounts. Inventory for a wholesale or retail company consists of finished goods for sale to customers. For example, you buy finished goods such as shoes and athletic wear from Nike, potato chips at Costco, school supplies at Staples, and a new shirt at Gap. The inventory of a manufacturer will consist not only of finished goods, but also goods in the course of production, work in process, and goods to be consumed directly or indirectly in production, raw materials. Manufacturers typically report all 3 types of inventory either directly in the balance sheet or in a disclosure note. A prepaid expense arises when a company incurs a cost of acquiring an asset in one period that will not be expensed until a future period. Examples are supplies, prepaid rent, and prepaid insurance. These assets are not converted to cash like receivables collected and inventory sold, but they instead are consumed in the future. Supplies are used, prepaid rent expires over the rental period, and prepaid insurance expires over the period of insurance coverage. Whether a prepaid expense is current or non-current depends on the period in which items are consumed. For example, if rent on an office building were prepaid for 1 year, then the prepayment is classified as a current asset. However, if rent were prepaid for a period extending beyond the coming year, then that portion of the prepayment that extends beyond the end of the coming year would be classified as a long-term asset. Here's a concept check problem for you. Current assets include cash and all other assets expected to become cash or to be consumed, A, within 1 year, B, within 1 operating cycle, C, within 1 year or 1 operating cycle, whichever is shorter, or D, within 1 year or 1 operating cycle, whichever is longer. Please pause your video to consider the question and choose your answer. Then start the video again to check your work. The correct answer is D. The criterion used to classify an asset as current is whether the asset will be consumed or converted to cash within a 1-year period of time or the operating cycle, whichever is longer. For most companies, 1 year will be longer than the operating cycle. However, companies constructing very large assets, such as ships or airplanes, may have operating cycles exceeding 1 year. Well, that's all for this video. In the next video, we'll discuss assets that should be classified as long-term assets. See you next time.